move on to capital. Capital, values today, acquisition market. We've both lived, I don't know how many economic cycles in the industry, three or four industry cycles, and then we just came through the worst.
Surprised
economy.
I don't have more gray hair.
I know,
right?
me too. But we've been
Surprised I'm still standing.
We have the worst economy in 75 years. That the market is roaring now. Capital has come back in abundance. We had record values across the entire
we're chasing
senior housing
yields.
and care spectrum. Is this realistic? I mean, we're way up here. We both know on the skilled side, LTAC side, you're going to have, reimbursement pressure is going to always be constant. On the senior housing side, we're going to have development pressure. But is this, you look at the overall market, is this the most bullish you've seen in your career?
Yes and no. It is, pre-PPS things were pretty bullish. Valuations were pretty high.
Nothing like today, even on an inflation-adjusted basis.
Yeah, you're closer to that math, but when I look at what we sold Allegis for at the time, that was a really pretty good valuation.
That's Maryland.
So
always high values.
Yeah, well, it was my partners and I. We did very well. We were blessed and shared that with our team. So that was a blessing too. Look, I think there's no question that the stratification of the cash flows that have enabled to, in a more tax efficient and in a more structured way, right? We've taken the cash flows upstream to either term debt or leasehold, REIT leases, have enabled people to secure that debt, those cash flows, and given where interest rates have been and spreads have been, to have 300 or 400 basis point. I mean, I'm not a financing guy, but that's really good living, right? I mean, when you're making 300 or 400 basis points over treasuries. That's likely to sustain itself to some extent over the next 5 to 10 years, because most people believe that they can maintain that spread even as treasuries move up 200 or 300 basis points. That's a question back to you, but I think that's not completely irrational.
What is irrational is when treasuries go up 100 basis points and REIT stocks drop 25%. To me, that's irrational.
It is always the quick inflections in the marketplace that allocators, hedge funds and allocators of capital who are smarter than me can probably take advantage of. Yeah. But if we're talking about fundamentals, then, good assets in good markets with good management and good cash flow that are not overly levered should produce good returns. But that means 1.3 coverages after a 4 or 5% management fee after CapEx, not 1.1.
Or in one case, below 1.0.
And that's the kookiness that I'll take you back to Roger Lippitz and Meridian, when he was on the Genesis board doing the multi-care deal. I mean, so some things change and some things don't. These are operating businesses. And if good financial partners understand that they got to invest in the real estate, they got to invest in management and the operations, to maintain market share, to be able to adapt to new payment models. If we don't make the rent so high that we can't manage length of stay declines and manage through, operators are pretty clever. They'll adjust, but they need time. So there's a place, but there's 1.5 million skilled nursing facilities, and many of them need to go away, and need to be replaced with 21st century products.
Now we have a bit of a paradox going on right now in the market. So we have this bull market in investing across the post-acute spectrum. But in senior housing and care, we have the smallest number of publicly traded companies, I think probably in 25, 30 years.
Because all the market cap is in the REITs. I mean, so look at the aggregate market cap of the REITs. That's where the cash. So if the cash flow of the skilled nursing facilities has been, and I'm not making a judgment call here, I'm just saying that that's the corporate finance. If the cash flow has been moved into the REITs and monetized into the REITs, that's why you don't have market cap and more public nursing home companies, because essentially all those cash flows have been monetized in the REITs. It's all been moved upstream.
Yeah, but then the ones that have not been monetized yet, no one's even thinking about going public. They're either going to do a private equity deal or a REIT deal. Because values are higher with them.
Because values are higher with them. So you say it's the same cash flows, and you put depending on what your risk tolerance is, what your coverage ratio is, and if you take that cash flow and you put it into a public REIT, at their cost of capital and their tax efficient, dividend construct, you get a bigger number, right? There's an arbitrage.
So does it only make sense to be public if you're a big company like a Kindred? Is that where the public markets are only going to favor?
Look, I mean, we are public because we were public.
Already.
And we are rightfully public now because we're not a nursing home company. We're not even a post-acute company. We're a health service company that offers a diverse platform of, non-acute outpatient services that are being positioned for a world where maintaining health outside of a hospital and managing care coming out of a hospital is more integrated. I mean, that is our strategy, and we're kind of distinct in that position. Not solely distinct, but certainly further along. I think that we are significantly better diversified, capitalized, and positioned, even if it takes 10 years to get there. That doesn't mean that can't be replicated at a regional basis with operators who try to do that. And it also doesn't mean that we won't have partners who are pure play SNF operators, et cetera.
And then I say
assisted living.
And then I make that comment about, well, is it only the Kindreds of the world?
But it's not only Kindred. Ensign's been very successful.
Yeah.
I think Genesis will be successful. George Hager is a phenomenal executive. And
then you have Brookdale, and so they're the largest senior housing.
And Andy's a terrific guy.
And look at the problems they're having as a public entity. You've got the CEO is looking at care, and the investors are looking at real estate value.
It's deja vu all over again. It's 13 years ago at Kindred. Andy will figure it out. I mean, look, my only advice to all these guys is, and we have not been afraid to do aggressive moves. So when we divested assets and we took our EPS from $1.30 per share to $1 per share, people thought we were crazy. And look at where we are today. I mean, so I think you have to sort of play the cards that you're dealt. You got to manage to your strengths. There are a lot of things that you can do on an enterprise basis in today's world that you can't do on a smaller basis. So you kind of have to play to those strengths if you're the larger companies. And there are opportunities there, but you got to sort of play the cards that you're dealt and manage them. And I was dealt different cards, and Brookdale's got different cards. But you got to aggressively play your hands. You can't kind of sit back.
Right.
That's the only thing I learned the hard way. You got to be on offense.
And I know you've had a lot of interaction with REITs, with Ventas and I'm sure with some other REITs, and you know all the players. And we know nothing's going to last forever. But everyone's basically talking about the healthcare REITs are really positioned as the most efficient investors in healthcare real estate.
I think that's right.
Can this last forever? I mean, is this what's gonna put an end to that, or what could put an end to that, other than interest rates going up 800 basis points?
Only if interest rates rise really, really quickly. Look, I've always said this. REITs are and this is sort of structural. REITs are great allocators of capital to real estate. They are, and they are great financing sources. There's nothing inherently wrong with a lease. It's just financing. HUD is a good source of financing too. For Kindred, good term loan, has been great financing for us. It's a little, you got to peel the onion back a little bit more. It's the terms of the lease. It's, are you aligned on to manage through operational change and reimbursement change? Are your escalators aligned with the underlying economic reality of the business? But I sort of challenge all my buddies, and friends in the REIT world to continue, and I think they are doing this, to get out of that, historical triple net lease box, and figure out how they're going to better align with providers to create new asset classes and new models where everybody participates in the success of the asset. And I think that's going to have to change for them to continue to be successful.
Yeah, I think one of the problems with, and I know it's on the private side people do it, is all the upside, if there is upside in that leased asset, all the upside on the value goes to the REIT.
Correct.
And they're and nobody wants to hear it, but some in between where you share in that upside, then the operator has something to look forward to, and they haven't quite figured out how to do that.
Create, and that's where you create the entrepreneurialism that you need. Look, the biggest challenge that we have in the skilled nursing industry right now is attracting people and talent. It's not capital.
There's no shortage of that.
That's the biggest challenge. In our talent management leadership development, we've done a pretty good job in our skilled nursing business, but we've done a phenomenal job of recruiting and building managerial capacity, in our other businesses. And that part of it is we got to make skilled nursing more attractive. And if we can't do it, how hard is it for others to do? Right. So I think the REITs will continue and structurally are the best position to allocate capital, but they've got to become more operator friendly. They've got to figure out how to align with operators more. They've got to help the operators figure out how to invest in the buildings, how to invest in the systems and process, and how to invest in management and talent development.
Well, let's talk a little bit, just for a minute or two, on your future. And you know the capital side, the policy side, the operations side. Skilled nursing, LTACs, rehab,
I know a little bit of everything, and there's so many people who know more than I do about all those things.
But and you're going to stay as executive vice chairman through March of 2016.
I'm going to stay around as long as Ben and the board thinks that I can add value.
Okay, it's not a one-year contract with that, or
well, that
title.
That deal is a one-year deal, and rightfully so, because I think that. We wanted just to create a further bridge. There's so much going on, and again, Ben and the team they're way ahead of schedule in terms of Argentiva integration and other strategies. So things are going exceedingly well. I'm just trying to help out various project work, Project Nova, helping prepare our LTACs for criteria, helping with the public policy stuff. And then I hope to stay on the board for a couple of years again, so long as Ben and the rest of the board think I'm continuing to contribute and staying out of the way.
I'm sure they will.
Well, and staying out of the way. So I got to behave myself too. Right. So.
Now I know. I mean, after being the CEO of this very large healthcare services company, I still like to call it post-acute care, but
we're more aspirational.
I know. Probably the last thing you want to do is run another public, $10 billion healthcare services company. But wouldn't it be fun to be the head of a REIT?
That might be interesting. I think that personally, I mean, I'm blessed beyond belief in so many different ways, family and health, and and stuff. And I mean, I've got so many people who at Kindred, who at Allegis, who at Mariner, I think I have incredible relationships with. And I consider my best success, I think I've done a pretty good job on my personal brand. You once accused me of being a nice guy. And I kind of laughed at that. I think I am a nice guy. That's not such a bad thing. You know, that has been a part of building great teams and building good companies. And so I'm really proud of all that. But I'm at the point of my life where I think it would have to be an extraordinary opportunity, you know, for me to compromise health and family to be an operator again. But if I can leverage some of my experiences and some of my capabilities in a way that isn't day to day, you know, I think that might be interesting. You know, but I'm gonna complete my 6-month sabbatical before I and my commitment to Ben and Kindred before I could really consider.
How about leveraging it with a large private equity firm where, I mean, they always love the CEOs who understand how to operate the business. So when guys are coming in with their plans and all that, you would not only understand how to run the business and whether these guys have what it takes to do it, but you know the business.
I think, you know, there are a lot of great private equity firms out there, and you know, I've got friends in some of them. Some of them have models, and I was a private equity backed guy at one point with Warburg Pincus, and Joel Ackerman is one of my closest friends, and he and I are dabbling in Guide On Partners, which is a little specialty private equity fund that we've started with Jim Carlson and some other managed care folks. I think, you know, whether it's helping a REIT maybe prepare for the next decade, or working with a private equity fund as a true partner, you know, those would be among the things that might be interesting. Okay. If you're forcing me to think about stuff, which I hadn't really thought too much, I'm trying not to think about it.
I know, you're relaxing.
I'm trying to chill.
And you're happily ensconced after all these years in Louisville.
Oh, Louisville's great. Louisville's home.
Is that going to be home for?
Yeah, I was just appointed by the governor to join the U of L Board of Trustees. So I'm looking forward to trying to help that, and I'm helping the mayor with his summer works programs.
Wait a minute, you mean it wasn't Randy Bufford who appointed you to that?
You know, he probably had a vote in it, but Randy and I have a good relationship. And again, he talk about a guy who's from the ground up done innovation the right way. I mean, you know, my hat's off to him. And you know, my friend and partner for many years, Greg Miller, is his CFO now. So it's just, I love the fact that, you know, whether it's Eamon Riley or you know, many others in the industry, you know, I've had a chance to work with people and Lane Bowen and many others. So it's, you know, there's a lot of ex-partners that are I think doing well out there.
Well, from a very selfish perspective, I hope you stay involved in the industry because I have enjoyed my 25-year relationship with you.
Our friendship's meant a lot to me too,
yeah.
And this industry's meant the world to me. And,
me too.
All the residents we've served. So
absolutely.
I definitely feel like I continue to owe back. So I'll try to find ways to give back.
I'm sure you will.
Good to see you, my friend.
Thank you very much.